Let's be honest about something before we even start. You've probably read books on trading psychology. You know what loss aversion is. You know what revenge trading is. You could probably explain FOMO to a beginner without even thinking about it. And yet, knowing all of that hasn't stopped you from doing it anyway. That's not a criticism. That's just what this is really about. And it's why most of what gets taught about trading psychology doesn't actually change anything. This isn't financial advice, and none of what follows should be taken as a signal to buy or sell anything. Think of this more as a conversation you should have had with yourself a long time ago. Here's the idea we're going to sit with for the next 20 minutes. Most people assume that becoming profitable is mostly about finding the right strategy, the right entry model, the right indicators, maybe the right mentor. But you can have a strategy that actually works, one that's been tested properly, one that other people are using to grow their accounts steadily, and you can still lose money with it. Not because the strategy failed, because you couldn't execute it. And if that sentence stings a little, good, because it means we're talking about something real. As your relationship with the market develops, you tend to move through certain psychological stages, and they're not neat, they're not linear. You don't graduate from one and never go back. You can be disciplined in gold and reckless in Bitcoin. You can feel like a professional on Monday and a beginner again by Thursday. What matters isn't memorizing these stages like a syllabus. What matters is being honest enough right now to notice which one is actually running your decisions today. It usually starts with something that has nothing to do with candlesticks. Think about why you actually opened your first account. Was it really about the money, or was it about something underneath the money? Independence, control over your own time. The feeling of finally building something instead of just showing up somewhere every day because you have to. That desire isn't the problem. Wanting more out of your life was never the problem. The problem starts the moment the outcome, your picturing, becomes more important than the process required to actually get there. You're not thinking in probabilities yet. You're thinking in outcomes. What will my life look like when this works? And that gap between how badly you want the result and how much skill you actually have right now is exactly where the next stage quietly begins to form. Here's something nobody tells beginners, and it should probably be the first thing anyone says to a new trader. An early winning streak is dangerous. Not because winning is bad, obviously, but because your brain can't tell the difference between skill and luck in the moment it's happening. It just registers success and wants more of it. You take 2 or 3 winning trades in a row, and something in you quietly decides you figured it out. Have you ever increased your size after a short winning streak, just a little, telling yourself you'd earned it? Most people have. It's one of the most common ways a decent account turns into a smaller one. Because bigger size taken on unproven confidence means the next losing streak, the one every single strategy eventually has, does real damage. And this is also where overtrading usually starts. Not because you're undisciplined by nature, because winning feels good. And some part of you starts chasing that feeling instead of waiting for the setup that actually deserves your money. Then comes the loss that actually hurts. Not a small one. The kind that wipes out weeks of progress in one trade, and suddenly you're staring at a red number that doesn't feel like a data point anymore. It feels personal. The first reaction almost never looks like calm analysis. It looks like shock. And right behind the shock, denial. Maybe you blame the broker. Maybe you decided the market got manipulated right at your entry. Maybe you told yourself the news was unfair. That reaction is human, but it's also exactly what stops you from learning anything, because blaming something outside yourself means you never have to look at what actually happened inside you. And from there, a lot of people slide straight into revenge trading. You know what that looks like. You lose on a USD position, and instead of waiting for your next real setup, you're back in the market 2 minutes later, bigger size, no real plan, just trying to undo the pain as fast as possible. Here's the part that's worth sitting with. In that moment, you probably knew exactly what your plan said to do. You did something else anyway. That gap between what you know and what you actually do under pressure is one of the most important things in this entire subject, and it's why reading another book rarely fixes it. Knowledge lives in the calm, rational part of your mind. Execution happens somewhere else entirely, somewhere pressure has a lot more influence than logic does. Eventually, painfully, a different question starts to show up. Not what's wrong with the market. What did I actually do? That's an uncomfortable question, and most people avoid it for as long as they possibly can. But it's really the first honest step forward. Once you get past blaming the market, the natural next move is to assume the strategy itself was broken. So the search begins. New indicators, smart money concepts, pure price action, liquidity models, maybe a new mentor who seems to have finally cracked the code everyone else missed. And for a little while, each new system feels like relief, like control again, until it produces its own string of losses, and the search starts all over. Have you ever changed your entire strategy after 3 losing trades in a row? Absolutely convinced the method itself had failed you? Here's something worth being honest about. That usually isn't really about the strategy. It's about how uncomfortable uncertainty feels, and how learning something new gives you a quick, comforting sense of progress, even when nothing has actually improved. Effort feels like the same thing as growth. It isn't. And there's a related trap worth naming directly, because almost everyone falls into it at some point. More indicators do not mean more certainty. If you've ever added a 5th or 6th confirmation tool to your chart, hoping it would finally make you feel sure before you clicked buy, you already know how this ends. It doesn't create clarity. Past a certain point, it just delays the decision until conflicting signals force you into a late, hesitant entry that isn't even the setup you originally saw. More information isn't the same as more confidence. Sometimes it's the opposite. At some point you land on something that's actually solid, tested properly, not just back-tested on the trades that happened to work. And here's where something strange happens, something that catches a lot of people off guard. The strategy stops being the problem. You do. You stop trusting yourself to actually execute it. You know what that looks like too, probably. Hesitating on a setup you would have taken without a second thought a month ago, because the memory of your last loss is louder in your head than the chart in front of you actually is. Closing a winning trade early, way too early, because some part of you is terrified the market's about to hand your profit right back to you. Have you ever closed a good trade early just to lock in something, anything, because you couldn't stand the thought of watching it reverse? That's not a strategy failure. That's your nervous system prioritizing the avoidance of regret over the actual math in front of you. And here's a distinction worth making clearly, because people mix these up constantly. Confidence is believing a trade is probably right. Emotional control is being able to execute it correctly, whether you believe that or not. You can feel completely unsure about a setup and still take it properly if your process is what's actually making the decision instead of your mood. That's the real beginning of separating who you are from how your last trade went. A losing trade you executed correctly was never a personal failure. A winning trade you took carelessly was never a personal victory. This is usually where discipline stops being something you agree with in theory and starts becoming something that actually holds. A position size you don't renegotiate in the heat of the moment. A daily loss limit that ends your session even when you're completely convinced the next trade is the one that turns everything around. Think about a prop firm evaluation sitting at 90% of your target with a few days left on the clock. That pull toward one big trade to finish early and just be done with it. That's real, and it's ended a lot of evaluations. The discipline required there isn't dramatic. It's boring. It's taking the smaller, correctly sized trade and accepting that finishing a little slower beats risking the whole thing. And it's worth saying clearly, discipline isn't the same as rigidity. Rigidity refuses to adjust even when the situation genuinely calls for it. Discipline holds the boundary while still leaving room for judgment inside it. Confusing those two turns some traders brittle, unable to adapt even when adapting is exactly the right call. When consistency finally shows up, it almost never looks like the smooth rising line you see in advertisements. You still have losing days, losing weeks even. What actually changes isn't the outcome of every single session. It's how stable the process behind those outcomes has become. A trader who follows their plan and loses is in a completely different position than a trader who abandons their plan and happens to win. You start judging yourself on how well you executed, not on what the trade happened to do afterward, because a good decision can still lose, and a careless one can still win. And mixing those two up will quietly wreck your progress without you even noticing. That's outcome bias, by the way, judging a decision as good or bad purely based on how it turned out. Break your own rules and get lucky, and you'll probably repeat the mistake, because the win just reinforced exactly the wrong behavior. Follow your rules perfectly and still lose, and you might start doubting a process that was never actually broken. Untangling those two things is one of the quieter, harder skills in all of this. And this is where things get interesting, because something shifts underneath all of it. It stops being about needing to win this specific trade, and starts being about simply executing your edge correctly, over and over, and letting probability do what probability does over a large enough sample. Here's something that took a lot of traders years to actually understand, and it might sound strange at first. You don't need to know what happens next. I know that feels wrong when you're sitting there watching the next candle form, but you don't. Your job was never to predict that candle. Your job is to recognize a situation you've tested enough times to know that, across a large sample, it gives you an edge. That's genuinely it. One single trade doesn't need to prove anything at all. Ed Seykota's trend-following work leaned on exactly this idea, accepting a high number of losing trades as simply the cost of eventually catching the move that made the whole approach worthwhile. The loss was never evidence that something was wrong. It was just an expected part of a process that worked. And risk management at this point stops being pure math and becomes something more personal than that. Position sizing isn't only about protecting your capital, it's about keeping your emotions out of the decision entirely. Risk an amount you can genuinely tolerate losing, and you think clearly. Risk even a little more than that, and you'll probably notice your judgment getting quietly hijacked by fear, no matter how skilled you actually are. Brett Steenbarger's work on trading psychology keeps circling back to this same point, that how well you regulate yourself under risk often predicts your results better than raw analytical skill does. At this stage, a losing trade doesn't trigger a crisis anymore. You can lose 10 in a row, if that's within the normal range for your edge, and keep executing, without concluding the method is broken. That's really the line between people who keep moving forward and people who stay stuck, cycling through the earlier stages for years. Holding a losing streak and a sound process as two separate facts at the same time without one collapsing the other. What comes after that was never about becoming unbeatable, and it should never be sold to you that way. You still lose trades. You still make mistakes. The difference is those mistakes don't destabilize you the way they used to. It has less to do with knowing more and more to do with needing less emotional stimulation from the market, less compulsion to always be in something, less need to be doing anything at all. You can watch a decent setup pass by and let it go because the conditions weren't fully there. You can step away from your screens for a week and feel nothing but quiet. Capital preservation and psychological stability stop being separate from your edge at this point. They basically become the edge itself. So here's the question worth actually sitting with, honestly, without picturing someone else's account while you think about it. Which stage are you in right now? Not which one you'd like to be in. Which one your actual behavior, your position sizing after a bad day, your hesitation on setups you know are valid, your habit of switching strategies the moment things get uncomfortable is quietly proving true about you. What are you still trying to avoid feeling? And what's the one thing, not a new indicator, but the one psychological skill that would actually move you forward from where you're standing right now? You don't become consistently profitable because you finally found the perfect strategy. You become capable because your relationship with uncertainty, with loss, with fear, with impatience actually changes underneath all of it. The market was never going to become predictable enough to save you from that. That requirement was always you. Trading was never really testing your strategy. It's testing your relationship with yourself. The goal was never to stop feeling fear. It's to stop letting fear make the decision for you. The goal was never to eliminate losses. It's to become someone who can absorb them without the whole process falling apart. The goal was never to predict every move. It's to keep executing intelligently inside a market that was never going to explain itself to you, no matter how long you waited. If this audiobook helped you recognize the stage you're in today, subscribe to Trading Psychology Audiobook, because the next stage of your trading journey may begin with the next lesson.